So we've had quite a lot of great questions coming through, and we're just going to run through them now and just do the best that we can. And we're going to kick off with a great question here, which is how much are global tensions, like the Middle East, likely to affect markets in H2? So I think, as we were talking about before, the geopolitical landscape has created a lot of volatility in the markets, but actually they have been fairly resilient. What we've seen coming out of the Middle East, what we've seen coming out of a continued grinding on in Ukraine, and really little sign of any kind of a solution there, hasn't seemed to phase markets the way that one might have expected. I think what is true is that it will create continued noise. I'd say the concern here is escalation. And I talk about concern there from a market and investor perspective. So if we start to see a material escalation, as we did in the Middle East, where we started to see worries around contagion moving into some of the peripheral countries around Iran and of course Israel. So if we start to see some escalation, that could be a concern, particularly into certain areas like emerging markets, but things like the oil price, gold impact, that sort of area. But broadly speaking, as we were talking about earlier, the geopolitical landscape, there is always something. As hard as it is to say, there is always something going on. So markets have an ability typically to be able to look through that. So we don't really see anything material coming out of H2 other than if we were to see escalation. How do you see investment opportunities in emerging markets? Perfect. India, China, and Brazil, etc. So, we've liked emerging markets for really quite some time now, and we just haven't seen that translate into performance, which has been frustrating. For us, one of the key areas has been the weakening dollar, which should play well into emerging markets, and in particular areas like Latin America or Southern America, where we do favour. So questions here like Brazil, obviously India, these are becoming sort of almost individual investment cases in and of themselves. But broadly speaking, we do like emerging markets. We like it particularly in the backdrop of a slightly weaker dollar, which should play through. We like it on the basis of valuations. We just need to see that start to translate through. So we have exposure within the portfolios and feel fairly positive on emerging markets going forward. How do you decide what really matters in the markets when there are so many different headlines going on? A brilliant question. And I think we could probably encapsulate that slightly by saying, when you see some of the noise, some of the narrative coming out, it is very, very easy to make a quick decision, be influenced by the emotion of the moment, by what you're seeing coming through from the Trump administration, for example, and the announcements on the so-called Liberation Day. So we tackle that by having a consistent investment process. And that provides us with a framework with which to consistently assess the economic backdrop, the key fundamentals for investment, takes into account certain shorter term factors, of which we may take into account things like tariff announcements, etc. But it focuses primarily on the longer term influences such as valuation, macro backdrop, so what does the economy look like at the moment, how favourable is it to a different asset class. And that enables us to look through the noise and be able to have a consistent discussion as a team within that framework of an investment process to be able to navigate what can feel like a shifting landscape at times. What are your thoughts in respect of asset allocation for the USA, international, and emerging markets in the next 10 years? A lovely question, one that we would probably want to be asked all the time, because almost the best mitigator of risk is time. It's time in the market. It's allowing time to play through and those returns to feed through, whilst you can ignore those short-term volatility and those big swings. So as a long-term investor, let's say a 10+ year time horizon, we would be pro-risk. We would take on equity exposure, we'd be overweight equity. I would have a favouring position against the likes of the US, where whilst you can discount some of the arguments around US exceptionalism and is that here to stay, but the reality is you've got a diversified market, you've got an entrepreneurial growth mindset that's embedded, and you've got global exposure there. But likewise, we have in Europe, in UK, I would be long-term equities overweight, and I'd be long-term overweight risk as a long-term investor. The reality, however, is that we have to navigate, and part of our job is to navigate some of the noise that comes through to make sure that we reach those long-term goals. And that's where the challenges can present themselves. Hence, having that consistent framework to understand the economic backdrop, to understand the valuations, what are the market and what are the conditions telling us, so that we can navigate a smoother pathway through to meet those long-term goals. But absolutely, it would be a luxury to be able to invest purely with that very long-term mindset in place, and we would be pro-risk. Next question here, are markets too reliant on a few big tech companies at the moment? I mean, obviously that's been a real subject for debate over the last year or so now, and something that we alluded to earlier when we were talking about Tesla. I mean, the likes of Nvidia, Microsoft, Apple make up an even more significant proportion of a market cap or size weighted index. So clearly they do have a significant impact, and it's something that has concerned us for some time. Just because you see stretched valuations, or in other words, share prices that have maybe got a little ahead of themselves, doesn't mean that that's going to change, because what you need to see is those growth rates continuing to come through and support elevated valuations. But it is an area of concern when you start to see that, and particular technology really dominate what others might think of as a diversified market. So it's something that we've been trying to address over the last 6 months to a year, where we start to see those valuations push through. Some of it coming through to actually adding into portfolios areas like a equally weighted index exposure and gaining exposure into actively managed strategies, which enables the manager to make a call on where they think the valuations are, where they think the opportunities lie within a given market, or globally or domestically. So certainly something that is on our mind, something that we are very aware of, and I think it does highlight some of the pitfalls of simply buying an index and thinking that you bought a diversified range of assets. I've got a more domestic question here actually for the UK. Obviously the FTSE reacted quite dramatically to Rachel Reeves' meltdown in the Commons. Did that surprise you? I'm assuming that this is talking to PMQs the other week, where Rachel Reeves, the Chancellor, was seen to be tearful on camera and in the House. What we did see is a reaction on equity markets in the UK market, which was fairly short-lived, but it did respond through. And to be honest, not really a big surprise. I think the concern was less of a human one, and you'd love to think it was a human reaction. It was less of a human one and more about the stability of the UK government, and in particular, the position of the Chancellor. Now, what we saw, I think it was the next day, where we saw the Prime Minister, Starmer, come out and openly and very publicly back the Chancellor in her role. But at the time, I think it was felt that he wasn't doing enough or saying enough, regardless of whether he was aware of what was going on, that he wasn't saying enough to back the Chancellor. And we all know in politics, if you don't say enough to back someone, then it probably means that their position is in threat. Sometimes if you say too much to back them, it means their position is in threat. But in reality, I think it was more of a reaction to what that could mean to economic stability rather than anything else. So not a big surprise, and I think the markets just settled down pretty quickly after. Do you still think politics doesn't matter in investment markets? That's, I think, playing to something that we were talking about towards the back end of last year and going into the beginning of this year, where our statement was politics doesn't really matter. And the rationale for that was that because developed markets are so indebted, there's very little room for maneuver. And I would absolutely stand by that. What we said at the time, and I'd continue to argue, is that politics matters greatly on a domestic level. On a global level, it can create a lot of noise. It can create some impact economically, but really it creates noise. But in reality, the room for maneuver that the likes of the US, the UK, Europe generally have to be able to drive rates, to be able to drive policy and fiscal policy is fairly limited because of the level of debt that they carry on their books. Now we saw this, and I think I was alluding to this earlier in the chat, we saw this in the States with the announcement, which did create a huge amount of noise globally, of the tariffs. That created a high degree of uncertainty, and the Trump administration stood by what they were arguing, and some of the levels of tariffs which were starting to become quite retaliatory as we started to enter into this sort of tariff war. Where we saw the turning point from the Trump administration was when Treasury yields started to climb significantly. And what does that mean? It means that the cost of servicing debt for the US economy starts to rise. So for them to borrow more money or to keep that level of debt going, the cost to service that, the income that they need to drive in, has risen significantly. And that creates a massive problem for the US economy. So once we started to see that happen, and once we started to see the NASDAQ, the equity market, really pull back significantly, the Trump administration stepped in and moderated their tone. They talked about holding back, delaying the onset of tariffs, engaging in constructive discussions with different nations, and the market settled back down. So I think it continues to create noise. What we've seen this year is absolutely heightened noise. But I still think over the long term, given the level of indebtedness, there's very little room for maneuver. Final question, and this is a lovely one to finish off on. What will happen to cash, paper, and crypto investments in the event of World War III? Well, I know what I'd be doing, and that's stocking up on baked beans and a bunker, and probably a can opener as well. But less flippantly, I think what it does do, I mean, that's talking about heightened geopolitical tensions, the potential for contagion, and where you start to see other nations getting involved. And that is incredibly concerning. From an investment standpoint, clearly there is an impact of that escalation, as we were speaking to before. I do think, the talk of using the likes of crypto currencies, the likes of Bitcoin, is obviously the sort of the poster child in that space, as being a safe haven asset. It's nonsense because there is no backing to that asset. Quite often when you see that escalation in conflict, maybe, and the impact that that can have, owning physical assets can be a positive thing. So the likes of gold can be a useful, oil start to become quite an attractive asset to own, given the need for those assets and the physical nature of those. Areas such as cash, obviously as a flight to safety, is useful. Typically speaking, we would like to think that there's more often than not somewhere better to put our money and your investments than simply holding in cash. So I do think it does play, though, to that idea of physical assets versus the sort of the new wave coming through as non-physical, and we would preference either physical assets or having a very sensible, diversified portfolio. And on that note, we'll finish there.